The day the stock market collapsed and took everything with it. In the late 1920s, America believed it had mastered prosperity. The stock market climbed relentlessly, fueled by confidence, speculation, and easy credit. Ordinary citizens became investors, pouring savings and often borrowed money into stocks that seemed destined only to rise. Bankers, brokers, and industrial giants moved in sync with a culture that rewarded risk and dismissed caution. Wealth was no longer built slowly, it was chased. At the center of this surge were powerful financiers and institutions who encouraged buying on margin, allowing investors to purchase stocks with as little as 10% of their own money. This magnified gains, but it also quietly magnified risk. Beneath the optimism, the system was fragile, dependent on the belief that prices would continue upward indefinitely. By October 1929, cracks had begun to show. Stock prices wobbled, and nervousness spread among investors who had never experienced a sustained downturn. Still, many dismissed the warning signs, trusting the market's past performance over its uncertain future. Then came Thursday, October 24, 1929, later known as Black Thursday. Panic arrived early that morning. A wave of selling orders flooded the market as investors rushed to cash out before prices dropped further. The ticker tape lagged behind real-time trading, creating confusion and fear. Crowds gathered outside the New York Stock Exchange, desperate for news, while inside, brokers struggled to keep up with the volume. Leading bankers attempted to stabilize the situation, pooling resources to buy large blocks of stock and restore confidence. For a moment, it worked. Prices steadied, and a sense of calm returned by the afternoon, but the damage had already been done. Trust, once broken, is not easily restored. In the days that followed, selling resumed with greater intensity. By Black Tuesday, October 29th, the market collapsed entirely. Billions of dollars in wealth vanished within hours. Fortunes that had taken decades to build were erased almost overnight. The consequences reached far beyond Wall Street. Banks failed as loans tied to stock investments went unpaid. Businesses collapsed, unemployment surged, and the American economy entered a downward spiral that would become the Great Depression. The crash of 1929 was not just a financial event, it was a lesson in human behavior. It exposed the dangers of unchecked optimism, excessive leverage, and the belief that markets are immune to gravity. The characters of that era, bankers, speculators, and everyday investors, were not reckless by nature. They were driven by the same forces that move markets today: fear, greed, and the desire to believe that this time is different. But it never is.